Hi, everyone. This is John Pokarova. It's May the 15th, 2022, and it's time for a general market update. A lot to cover. So, again, this presentation is made by Rain King LLC, and I myself am an amateur individual growth stock investor, and I'm not affiliated with IBD or MarketSmith, but you will see charts from IBD and MarketSmith. So the agenda today is packed, lots to cover, the big picture, some internals. We'll talk about the Fed and bear markets. Then we'll touch upon market bottoms, and probably the most important question is, what should we be doing now? So let's get back into the big picture and let's take a real good look at it again. I usually start presentations talking about the market super cycle, and on the screen is the 1974 to 2000 bull market cycle, which was driven by the baby boomers. And it was a long run to the top in 2000, but you'll notice there were bear markets that happened along the way. And I've been using that precedent as a current super cycle that we're in, that started in 2009 with the bear market bottom. And if you forecast potentially another 26-year super cycle being led by 84 millennials in their peak consumption years, that would take us out to 2035. But the important thing to understand is that there are bear markets along the way: the 2018 bear market, the 2020 COVID bear market, and the market that we're in today. So this is the monthly chart of the Nasdaq updated at the end of April, with some very long-term trend lines drawn. And I've used this before, where I said the market could come back down into the 11,000 area, which would be about a 31% decline, and we could still be in the super cycle. So it's really interesting because we're starting to approach these levels. And if you use the upper trend line, it's roughly around the 11,000 area, and it's really a range, because if you use the lower trend line, you'll notice that we're closer to the 10,000. So I've drawn this yellow box to represent kind of between 10,000 and 11,000 as support, long-term support. So let's look at the Nasdaq. The Nasdaq has been basically in a straight down move with very few rally days. It's been about a 22.5% decline in 30 days. It's very weak. Growth stocks have been hammered. This is that reference point that I mentioned between 10,000 and 11,000. And I had mentioned late last week that we were starting to see some change, meaning we were seeing the selling start to accelerate. The Nasdaq volume picked up a little bit, but more importantly, we saw a lot of growth stocks really hit some extreme high volume levels, which said that maybe, and I use the word maybe, we get a short-term rally that might last beyond a few days, but we'll have to see how it goes. Now, the S&P is shown here. And since we last spoke, we have undercut the low of the last follow-through day, number 2. So that rally is officially dead when we undercut that. And, we had the Fed meeting in here, and the selling accelerated even in the S&P after the Fed meeting, where the Fed confirmed its aggressive stance. So now the S&P is off 20% from its highs. And now we have 2 failed follow-through days within 3 months. And, according to the data that I keep, we've really entered bear market territory. Now, if the decline gets to the 25% level, we would be in what I would term a major bear market. And I'm going to speak a little later about what major bear markets look like if we get there. So now let's take our attention and move it to the market internals. So these 2 charts is the S&P on the left, the Nasdaq on the right. This is looking at the percent of stocks that are above their 200-day moving average. The S&P has about 30% of the stocks, a little bit propped up because of some of the late cyclical names, but still very weak. The Nasdaq is even worse. You can see the Nasdaq only has approximately 9% of the entire Nasdaq is above the 200-day, extremely low level. The AAII, American Association of Individual Investors, this is the number of bears on the left. You see it's been gradually increasing, and we were at extreme levels. About a week ago, we had almost 60% of the survey was bearish. And if you take the AAII bulls, subtract the bears, you can see we're at levels that are extremely low levels. We are actually lower than the COVID low, which is shown here, as well as the market bottom from the December 2018 level. We were extreme levels on the retail investors side. This chart is of the NYSE and looking at new lows. Now, as the market made new lows in the S&P, you'll notice that actually we've been accelerating and increasing the number of new lows on the index. So actually it's a situation where we have new lows are confirming the lows that we're seeing in the index. So things are technically in sync to the downside. Not a great message if you're a bull, but it's important to know that right now there's confirmation. Lows are picking up as we hit new lows. If you look at the new lows in the Nasdaq, we have an acceleration of new lows, which, is again speaking to as we hit new lows, they're being confirmed with the index. Are we near a bottom yet? It's really, really too early to tell. What I don't want to see new lows increasing like this. You'll notice that even after the COVID crash and we had extreme new lows shown here, you'll notice that shortly after that, the new lows dried up after all of this panic selling. So if we're going to get a rally in the NASDAQ and the S&P, we want to see these new lows really start to decline and start to dry up a bit. That would be much more constructive. This is the National Association of Active Investment Managers. These are professionals. And this is a 2-week moving average of their exposure level to the market. So you'll notice here that the current exposure level is approximately 25%. And you'll notice that very quickly in the last month, they've gone from being 82% invested in the market to down to 25. That's a very steep decline. I've overlaid these colored zones. Typically, you'll see exposure levels of professionals, active managers get between 30 and 60% during corrections and down to 10 to 20% during bottoms. We're not quite that pink level yet, but we'll have to just watch this carefully. Two other sentiment indicators that I keep track of are the total equity put to call ratio. And also, I do take a look at the VIX periodically. Now, if we look at the put to call ratio, we're not really seeing extreme panic and extreme fear that we usually see around market bottoms. Yes, things spiked, a couple weeks ago, but they've actually come down as some of the selling has accelerated. So you see this is the COVID lows where panic and fear was much higher. On the VIX, again, we don't see a spike in the VIX of the nature that we had a couple times during 2020. So we're not really seeing what you'd like to see to form a market bottom. It could suggest that we're going to grind our way even lower before we actually find a bottom. Now, it's important to note that sentiment indicators like the put to call and the AAII, they are secondary and tertiary indicators. They'd be nothing that I would use to trade off of. Those sentiment indicators could last for months before we see a bottom. Last we spoke, I had mentioned the commodities, and I had tried to show the relationship of the index, in this case, the NASDAQ in the dark line, and how it related to commodities. And I used the 2008 rally in commodities as an example. Commodities in 2008, after a brief bear market rally, it was about 2 months after that the commodities topped. So, the commodities have come under pressure. in the last 2 to 3 weeks? Are they peaked out and we've topped out? Well, we don't know yet. But I wanted to just check in on those. And I had tweeted a little bit how a stock comes back into the 50-day moving average, call it the angle of descent. And I had shared, it's much more constructive to see a stock come in at a very shallow angle of ascent, either a 10-degree angle or even a 45-degree angle, with essentially the 50-day moving average catching up to the stock. When you get to a 60-degree angle, 70-degree angle straight into the line, that is a much more cautionary pullback. And I showed an example. This is Apple in 2004, 2005. You'll notice that this pullback here was about a 30-degree angle. And really the stock went sideways and formed a flat base as the 50-day in red caught up to the stock. Very, very constructive. It was about 11% pullback. You'll notice that later in the move, it's a very steep debt line approach to the line. And usually when you come into the line that steeply, usually the stock probably needs to base out. And that was the case with Apple. You can see it on the weekly chart on the right. It actually formed a large base. Now, if we go back to the commodity stocks, here's Mosaic, very steep into the line. Tech Resources, another one very steep into the line and undercut the line. Both are below the line of 50-day right now. And so that usually means I would imagine they could either base and reset themselves for another leg up, or it's possible that the commodity stocks have completely topped out. Now, Devon Energy on the right, which had a very steep decline, you'll notice it had a very, very quick recovery. So it's definitely one of the stronger names in the commodity space, in the oil space, and it's actually near new highs. So we'll have to see how this works out, if there's bases going to be forming, or does the complete commodity complex roll over. So let's move on to the Fed and talk a little bit about bear markets. So the economic cycle, I think the last time we met, my era was a little bit higher, relative to this cycle of economic activity. And I've kind of moved it down a little bit. We're getting even later and later in the economic cycle. So, the backdrop and the current environment has a series of headwinds. So, it certainly seems that we are starting to experience the big unwinding of QE, which started way back in 2009. And certainly record inflation numbers seem to be the villain that is forcing the Fed to start to really unwind this, decade-long quantitative easing. The hawkish Fed is made it very clear they're going to be aggressive about rate hikes. They just completed their second rate hike of 0.5 point, and we saw how the market reacted to that. In addition, the Fed has stated they're going to be reducing the balance sheet starting in June with quantitative tightening. This is another headwind. Can the markets really withstand that kind of beating, that kind of negative influence? It affects the liquidity of the market. And this aggression, could put us into a recession. And a recession is really defined as 2 consecutive negative quarters of GDP growth. And last quarter was negative. So we'll have to see how it plays out. But there are certainly large headwinds, and the Fed is not on our side. I've used this graph before. This is the S&P, and it starts to look at the pace of Fed rate hikes. The green line that you see here is when the Fed is not, tightening, and it's the average of the S&P. Pretty good. But you'll notice that when the fast tightening cycles occur, which are shown in this bronze-colored line, here's when the first rate hike takes place, and you can see the first 5 months after the first rate hike, generally the market does not perform well at all. If anything, and then there's a rally, and then it kind of goes sideways, and very little progress is made in the first year with rate hikes. So, inflation is very sticky. It is not something that you can just have a rate hike and make it go away. It's a very, very tough competitor. We also have midterm elections. The White House has certainly made it clear they're going to do everything to fight inflation in coordination with the Fed, it seems. We also are going into a seasonally weak period of the market. The summer is usually a very slow period with low volume. We know that the fall, September and October, if you know your market history, can be very treacherous months. But they can be seen as opportunities coming out the other side, because many markets have bottomed in October. So clearly the market is seeing a very rough landing, and they're certainly seeing and looking ahead, they believe probably that there's going to be a recession, and the market is starting to discount that with the heavy selling that's going on. This chart, again, I've used before, and I've used this to demonstrate in the 70s when inflation spiked from the 3% range up into 1973, around 9%, and then going to 12%. You can see that the Fed had to really raise rates aggressively, and the market had a very devastating bear market in 73 and 74. But you'll notice that, even as inflation came down, it did not go away. 6.9, 5%, 6%, and it started creeping back up. By 1978, we were at 9% inflation. And it really wasn't until the Fed had to really be super aggressive, and rates had to move to 18% to really start to slay the dragon of inflation. It's a very formidable competitor. So the headwinds are against us at the moment. And we have not seen this kind of devastation in the markets really since the dot-com bust in 2000 to 2002 bear market. And it's important to note, Cisco, which was one of the greatest stocks of the 90s, fell by 90%. That was just inconceivable. Cisco was like the darling during the bull market in the late 90s. Intel was one of the top chip companies, came off 83%. So everything was taken down and taken apart. The great financial crisis in 08-09, I just noted Apple, which again was a stock that was high flying between 2004 to 2007, came off 62%. And GE, probably one of the biggest blue chips, was off 87%. So the point being that, this idea that you can hold good growth stocks is really a misconception. No stock, I don't care how good you think it is as a company, we own stocks. We don't actually own the actual company. So they can't be held blindly. Crypto is under severe pressure. There's been some crypto implosions. And this chart here is showing that the total market cap in the crypto market, which was approaching 2.85 trillion, has had 60% market meltdown in the value of crypto. And I think we all saw Luna, which went from approximately $100 a share to less than $1 in literally a couple of days. So there's these are the types of things that happened during the dot-com bust. There's been devastation in growth stocks. C Limited, big winner from the COVID lows, is off 86%. Hard to believe. Upstart, one of the hot IPOs, is off 94%. Shop, probably one of the best growth stocks of the last 5 to 6 years, off 83%. And Net, Cloudflare, is off 77% off its highs. And these are just a scattering. There are literally dozens and dozens of stocks in this wreckage. And on the ETF side, the ARK Innovation Fund, which is Cathie Wood's flagship growth fund, has really been the poster child for this devastation and frankly, denial. It's 78% off its highs, and it's actually completely round-tripped all of its COVID gains. So I think, there's a lesson here about the markets. We follow the markets, and you cannot get stubborn with the market. Cathie Wood has been averaging down millions and millions of dollars she's losing, and she continues to average down. This is really a recipe for disaster, whether you're an individual investor who is averaging down. As you can see, also professionals can get them into great trouble taking that approach in a bear market. This is the S&P as of Friday, daily chart. And I've just marked levels. Some of the definitions I use for pullbacks and intermediate corrections, we're 20% off in the S&P. This zone here in pink is the 20% level. I mentioned that if we get to 25% off the highs, we really will enter what we'll call a major bear market, and that level is shown on the chart here, 25%. It's not that far away, but we may never come down there. In 2018, we actually came all the way down and had a big decline, but the market regathered itself and moved higher. We'll have to see how it plays out. So using my data regarding bear markets that I've gathered over the years from a couple different sources, and I maintain it myself, is using the S&P. And so, when you have new lows after 2 failed follow-through days within 3 months, you've entered really a bear market. The question now is, how devastating and deep will the bear market be? As I mentioned, the S&P is 20% decline in 129 calendar days. So if we reach the 25% decline range, that would be a major bear market. So the statistics that I have on major bear markets meeting this criteria, there have been 6 major bear markets since 1971. The average loss in those 6 major bear markets is 39.8%. So you can see that's almost double where we are today. And it averaged about 546 calendar days to the eventual low of the bear market. Now, so when you get into bear markets, they're measured in months and years and not days and weeks. So major bear markets take time. And if you're interested, over those 6 major bear markets, there typically are 7 failed follow-through days in those bear markets. And currently, as you know, we've had 2 failed follow-through days, and we're waiting to see if we get our follow-through day number 3. So market bottoms. I tweeted out last week, really, from my experience in the markets, there are 2 ways that markets bottom. There's either capitulation, which is panic selling on huge spikes in volume where everybody just throws in the towel, or there are extended downtrends, slow grinding downtrends where selling keeps exhausting itself and eventually selling completely dries up. So I included some examples for you to look at if you want to study those. And it's important that constructive bases that show accumulation take time, weeks to months to form. So we're nowhere near seeing those types of bases in growth stocks. The psychology of the market, is like a roller coaster. It's a slow build on the bull market side, and we slowly reached euphoria. But when things tip, they come down very, very fast. The emotions of fear and panic are much stronger than greed and complacency. So the ride down can be a lot faster, and people get very scared. You've taken losses. There really is a bad situation, usually bad news. And you'd say, well, where do you think we are on this emotional roller coaster today? If I were to, give a guess, I think we're somewhere in here. There definitely is some fear starting to build in the markets, but I don't think we've reached panic and capitulation yet. So we'll have to see how it plays out. Again, the 2018 market bottom, I showed this as an example. This is the climax type of selling. Straight down move, wide range bars, and you can see that the volume spikes to higher than anything else you've seen. That's panic capitulation selling, and you'll notice that actually in 2018 marked the bottom. And these were the tickers and when they were actually breaking out with the follow-through day. The 2000 to 2002 market bottom was an extended downtrend type of bottom, which had selling gradually with each low in the market, selling gradually dried up. And then we finally got a follow-through day that actually got some traction. And these were the tickers of some of the stocks that broke out during that time frame. And you'll notice that there are a series of them will usually break out before the follow-through day. So if we were to look at the March 09 bottom, let's take a look at this in a little more detail. So I wanted to, say right now, what we're looking for is we're trying to get a rally, a good rally attempt, and hopefully we get a follow-through day, which will be follow day number 3, which is a 1.25% gain as a minimum. We really would like to see 2% or more on big volume. So I'm not going to cover all the stuff in gray. We'll save that for another time. But right now, in the immediate term, we're looking for a follow-through day. So back to the 09 market, I wanted to show the correlation and what you should be looking for. The Nasdaq composite is shown at the top here in 09, 08, 09, and you can see as the market was making new lows, and I'm showing Netflix, right below it. You'll notice as the market makes a new low, Netflix did not make a new low. That's important. That's showing relative strength of the stock. You'll notice that the Nasdaq worked its way even lower and made another new low where I'm showing, but Netflix actually went sideways, again, showing relative strength. It did not make a new low. And then when the market made its final low, you'll notice that Netflix was actually breaking out. It had formed a little cup with handle, and it was starting to move higher. And it was about 3 weeks after that low that the actual Nasdaq composite broke out. And it was that point where Netflix started to really move with the market. It eventually went out to almost an 800% move. On the right, same March 09 timeframe, this is Chipotle. Again, Nasdaq on the top. Nasdaq makes a new low, Chipotle makes a new low. But on the last low of the Nasdaq, you can see here, Chipotle was not making a new low. It was forming a cup base. So you can see new low in the index, not a new low, but Chipotle. And eventually within 1 week of the follow-through day, Chipotle Mexican Grill broke out. It built a constructive base, and it went on to over a 500% move. So you're trying to correlate what the indexes are doing with growth stocks that are showing relative strength. So what to do now? So the last 4 or 5 months of the market have been extremely difficult. You probably have been kicked around a little bit. You've probably lost money. And the real challenge right now is you probably feel bad and you've lost your confidence, and including you might have lost, money, lost gains that you had from last year. So if you're in cash now, you can't make the money back right now. And that's really, really challenging, because sometimes when you want to get back in there and say, geez, I really, really want to make the money back now, but you must sit and wait for the right opportunity to re-enter the market. And that could be months from now. And this is where patience is really important. Right now, the winds, are against us. Now, if you've been in cash for the last few months, great job, great discipline. It's a great time to summarize what you've been doing right in your post-analysis, and that might mean simply outstating cash. I would look at the last bear market rally as a great place to start your post-analysis. We had that rally. It looked pretty convincing at the time, but there were some signs that the internals were not right. So ask yourself questions. Were you faked out on that rally? And what I mean by that is, did you plunge back into the market? Did you put too much exposure on too quickly? Did you try bottom fishing these former leading stocks that were actually in decline, in downtrends? That can get you into trouble. Did you control your risk? Did every individual trade that you take, did you control your downside? And if you got in the market and took multiple positions, did you protect yourself as a portfolio risk? So doing this is helpful to do right now, and because you might need to create some new rules for yourself going forward. And the most important thing is preparation. You want to stay engaged with the market. Just because you've lost some money or you've been kicked around and you don't think the market's really in a good spot, which it isn't, You still need to stay engaged and follow your routine. Follow your daily routine, follow your weekly routine. Do your screening, build watch list, and look for relative strength. Just as I mentioned, Netflix and Chipotle. If you were not doing this on your daily and weekly screenings, you would have missed those stocks, and they had multi-fold moves. You don't want to miss them. Because it's all about really being prepared for when the market turns up. Now, we don't know when that will be, whether it's weeks from now or months from now or a year from now, but you still want to stay engaged and prepared. So that presentation is over, and I wanted to remind people that the Boston meetup is having its next meetup on May 19th, Thursday. We are privileged to have Floyd Dameron, who is the Anchorage, Alaska IBD meetup leader. And he has a really back-tested strategy for using leveraged ETFs, particularly the TQQQ, which is really an interesting presentation. So if you'd like to join us, it's a free presentation. Go to meetup.com, search for the Boston IBD meetup, and the description of the talk. At the description, you'll see a Zoom link, which you need to fill out, and you can register and get the link for the event. We'd love to see you there on Thursday. And next weekend, the San Francisco meetup is having a 2-day Saturday, Sunday event. I will be speaking on Sunday morning, I believe it is. And I will be speaking about the anatomy of shakeouts and shake-ins. Try to take a little bit of the mystery about how these work and how institutional investors think and play their cards. So if you're interested in that particular session, you need to register. You can do that by going to my Twitter, which is on the screen. Go to my pinned tweet at the top of my profile. You'll see the link that'll take you to all the details about how you register to see all of the presentations Saturday and Sunday. And again, my talk is listed there. I believe it's on Sunday morning. So I know that it was a long session, but we haven't talked in a while. So I'm glad you attended. Hopefully this is helpful, and we'll see you all at the next general market update.